Well, good morning and welcome to this morning's webinar, Taking the Floor, Models, Morals and Management in a Wall Street Trading Room. I'm absolutely delighted to be chairing this session with Professor Daniel Beunza, a Professor of Social Studies of Finance in Bayes Business School, and we're really looking forward to this session. You probably know me by now. I'm Mike Wardle, the CEO here at ZN, and it's my pleasure to take the chair today, but my job really is to give space for Daniel's presentation. So just a few bits of housekeeping, if may. First of all, thanks to our sponsors. We're very fortunate at the FS Club to have a group of supporters who enable us to run this webinar program and other activities, and we really are very grateful. The program this morning is very simple. My job is to take really a couple of minutes to do the introductions before we have a 20-minute presentation from Daniel and then Q&A session between 11:25 and 11:45 when we'll close. The session's being recorded today, and there will be a recording available up on our website in probably a couple of days. An opportunity for you either to go back and rewatch because it's so fascinating, or indeed to share it with friends and colleagues who you think might be interested in the topics raised today. If you do ask a question, first of all, the thing to know is how to ask a question. If you haven't used GoToWebinar before, you'll see on the dashboard on your screen there's a question tab. If you open that up and you can type in your comments or questions, and we'll deal with those during the Q&A session. You can put a question at any point during the session today, so as it pops into your head, please do type in your question. And if you do ask a question or put a comment in, we will pass on your contact details to Daniel after the event, so if there's a need for further dialogue or discussion or whatever, we can enable that. So that's all by way of housekeeping really and introductions, but it's a really, really great pleasure to introduce Professor Daniel Beunza, a Professor of Social Studies of Finance at Bayes Business School. Daniel, over to you.
Thank you so much. So let me share my screen. Well, thank you very much, Michael, for this very kind introduction. And I thank you, all of you, the attendees, for being here. The topic of my presentation, which is the central topic of the book, Taking the Floor, is a new approach, a sort of like new weapon, if you will, that the regulators across the world have developed in about 10 years ago to deal with the problems they saw in the financial sector. And this weapon is none other than culture, and specifically the organizational culture in financial institutions. So what I'm showing you here is a photograph of Bill Dudley, the CEO of the New York Fed, back in 2014, where he gave a talk where he laid out very clearly that bank culture was going to be the new focus of the supervisory efforts of the New York Fed. And of course, it wasn't just the Fed that focused on culture. It was also a number of studies, including the Salts Review in the UK, that found that part of the reason why we had seen the problems we saw back in 2008 at the time of the global financial crisis was that the banks were engulfed in a culture of edginess and winning at all costs. And culture as well, which, by the way, Dudley defined as what people do when no one is looking, meaning the implicit norms that people adhere to in an organization. Culture was also the focus of the parliamentary commission that was created in the UK, in which published its report in 2013, and then the creation of the Banking Standards Board, which later on was renamed the Financial Services Culture Board, which was developed to promote high standards of behavior and competence. So in a nutshell, bank culture became around the middle of the past decade as the central focus that complemented regulatory efforts to improve ethics in financial services. Now, of course, the challenge that you have when you regulate something symbolic and difficult to put your finger on, such as culture, is that you can run into difficulties where the regulated or the supervised organizations develop a formal symbolic compliance with it. So let me show you here the type of situation that I was seeing back then. So this is the lobby of a large bank in Canary Wharf. We will not go into details as to which one. And this is the type of thing that you often saw back then. These huge signs with the values of the bank, or at least the values that the bank said it was espousing. The problem, of course, is that as impressive as this looked, when you spoke to the people at the bank, what they told you is that, well, look, the lobby is all changed, but when I go through the entrance up the lift to my desk, actually the activities that I'm doing have not really changed in any meaningful way. And so the trouble with trying to intervene on culture is that there is this danger of having slippage between the espoused practices and the actual practices in the organization. How do you then actually change the practices of the organization? The challenge when it comes to financial services is that the decision making in the organization is complex and is shaped by economic models that dictate, for instance, the value of certain securities, whether it is Black-Scholes, Gaussian Coppola, or others. It's not as simple as, well, we have new values, we're going to get rid of the economic models. So then how do you then integrate those? And so that, in a nutshell, is the question that interested me when examining this situation: how to improve the culture of organizations whose decisions are shaped by economic models. And in order to talk about this, I want to go back to September 2008 and the time of the bankruptcy of Lehman Brothers. Back then, I was a young lecturer in the US, in New York City. I was on the faculty at Columbia Business School. The business school had hired me on the strength of some field work that I had conducted in a trading floor in the style of an anthropologist, but instead of studying native villagers in a remote continent, I spent my years of doctoral studies studying traders in a trading floor. And so back then, September 2008, it seemed that the world was about to come to an end, and the headlines in the press were dominated by news of these traders that were getting millionaire bonuses, and at the same time were engaged in these reckless trades that were taking these banks into bankruptcy. And so my colleagues naturally asked me, well, Daniel, what do you make of this? And the trouble I had was that back then I didn't know what to say, because the behaviors that were being portrayed in the press were so different from those that I had seen while doing my own fieldwork in a bank. The traders that I had seen were ambitious, of course, but also prudent and in some ways principled. And so not knowing how to join up the worlds that I had seen with the headlines that I was getting, I decided to not say anything. The mystery, however, was revealed a month later, as I had the opportunity to, in my office, go through the tape of a presentation that the manager of the bank that I had followed for 3 years gave to my MBA students in the business school. So what I'm showing you here, it's an actual classroom at Columbia Business School. And what I'm showing you there is a presenter that was not quite the gentleman that had come to the classroom, but the situation, the image is very similar. And this presentation took place in October of 2007, so a full year before the bankruptcy of Lehman Brothers. Back then, the manager whom I had invited to speak to my students, I was hoping that he would explain the ways in which culture can be managed, but instead what he did is he was extremely critical of banks on Wall Street. He said things such as the Wall Street banks, they're badly managed, they're too large, too complex. And of course, anybody can say this, but this was coming from the actual manager of an equity derivatives trading floor. And so seeing that the students were sort of like having a hard time connecting with the message, he actually made his point even more clear. And he said, mark my words, he said, when the next crisis comes, not one, but 2 of the large banks will disappear. So this was October 07. When I watched this tape after September 08, my jaw dropped and I realized that exactly 2 banks had disappeared and that he knew something that I didn't. And so what I then understood is that the trading floor that I had spent 3 years observing, which he had been running, was in fact not quite representative of the rest of Wall Street, but instead it was illustrative of how a different Wall Street might be organized with traders that do not engage in excesses and that where you don't see problems of opportunism. So what I decided to do was go back to my field notes, recode the field notes, do additional observation, this time not with the purpose of understanding arbitrage or derivatives trading, but in fact with the purpose of really understanding what had been going on in that trading floor that made it different from the others from a cultural and an ethical perspective. So let me then talk a little bit about that trading floor. This is how it looked like. It was engaged in proprietary trading, and the manager had come to the realization that there were lots of synergies to be had from exchanging information between the various desks, but he had trouble getting the traders to informally share with one another. As a naive interviewer, I asked the boss, why was that a problem? Why maybe not just pay a bigger bonus to the traders if they wanted to informally share? And he explained that using the bonus as a tool to prompt behavior was widely done on Wall Street, but it entailed then a subjective evaluation at the end of the year about that behavior, which then could cause problems because if the boss does not give the trader the same bonus as others, he may very easily go, well, I heard Joe at a party, he got 500,000. Well, don't you like me? And so create a sense of injustice. And at the time, I didn't quite pick this up, but then as I recoded my notes, I realized that what Bob, which is the pseudonymous name that I give to this executive, was really talking about is the problem of organizational justice, which is something that has been developed in the field of organizational behavior. And it's the idea that perceptions of injustice impact job attitudes and behaviors at work. meaning that people are not simply motivated by the economic aspect of the rewards, but also by the extent to which they are feeling fairly or unfairly treated. So as I continued doing fieldwork in the trading floor that this gentleman was running, and in fact moved on to study a different bank that he was running back in '08, I then understood other aspects of what he was doing. On the day that I invited this gentleman to my classroom at Columbia Business School, we had an interesting exchange. He explained to me that he was puzzled by the fact that some of the students had shown up late to class. And so he said, well, look, that's a problem that I actually never had. And I said, well, is that right? And he said, yes. Back when I was running the trading floor, we were in a retreat, and the co-head of the trading floor and others came in, but they came in late. And so the co-head was peering into the session, and everyone else was looking at me. And I have been very explicit that people had to be on time. And so the question came, well, can we come in? And Bob went, actually, no, none of you can come in. You have to spend time with me alone, and that's going to be your punishment. He made it into a joke. But essentially, he was aware that the reputation that he would develop from these interactions was critical. And what that made me understand is that norms, and not just simply incentives, were key to what Bob was doing. So while most people in finance talk about how behavior is to be shaped by incentives, the focus of what he was doing was norms, what is acceptable and what is not. Now, at the core of the problem that he was grappling with is a central aspect that only then became clear after subsequent conversations, when we began to explore the previous experience that Bob had had in financial services. Between 87 and 95, he had worked at one of the leading banks in over-the-counter derivatives. And his crucial experience was with the introduction of value at risk, models that determine the potential risk that the various traders are incurring in, and that force those traders to close a position. So the bank introduced this as a way to help Bob, but to his surprise, the traders absolutely hated it. And they spend their days trying to sabotage the system and trying to circumvent the restrictions. The reason for that, Bob explained, is that the model creates a simplified, oversimplified, and in many ways simplistic representation of the strategies followed by the traders. The very best trades oftentimes are contrarian trades. They generate losses for some time, but then they quickly revert back up to profits. And then it's at that time when the value at risk models typically forces the traders to close the position. And the traders, even once they are forced to close the position, they not only have to then quickly sell at a loss, but also then they can also quantify just the extent of the profits that they have to give up, the returns, which also means, of course, the bonus that they have to give up. And so, as a response to the sense of being unfairly treated by this automated control system, what the traders at Premier Financial, the previous bank at which Bob was working, began to experiment a sense of, well, I don't care. If I'm going to be mistreated and treated unfairly by the bank, then I'm going to start to not care about anything and not feel bad when my own norms are being sort of like not followed. This is a behavior that has been researched in social psychology and goes by the name of moral disengagement, which is the perception of unfairness that leads to the detaching of immoral behaviors from the self-condemnation or other negative emotions. this self-condemnation is what makes us follow norms. But when people experience moral disengagement, they disengage with that mechanism. And basically, you have something akin of a free player in an organization which can just simply pursue his or her self-interest. So very dangerous. So what emerged from these conversations and interviews is the idea that the introduction of mechanistic control systems based in economic models, such as value at risk, pose a risk of moral disengagement. And this is something that I defined as a weakening of self-condemnation caused by the perceptions of injustice associated with the use of models to manage the organization. So in the 1 minute that I have left, let me tell you a bit about how to address this problem based on what I saw. So how to prevent moral disengagement? Well, at Bob's trading floor, what I saw was a limited size, 260 traders, so that people could know each other more or less, preventing businesses that Bob thought just were too tempting, create too many opportunities for actually opportunism. Bob did not rely on economic models and risk management data in order to decide whose position needs to be closed. Instead, he walked around the trading floor and developed a couple of middle managers that worked for him. And everybody had in-person conversation with these traders. He avoided the use of subjective bonuses and paid a simple percentage of the tradings generated at each desk, which is also, how hedge funds compensate. And he developed, like I said, these middle managers. And so what I would like to do is close with the idea of proximate control, which is how I think of all this, which is a number of measures, such as the ones that I showed, that reinforce organizational norms and social relationships at work. And so instead of relying on an abstract mathematical model that is being deployed by a separate unit in the organization, risk management, instead preserve a sense of justice and sustain the moral mechanisms of self-condemnation that the traders themselves typically have when their own norms are breached. So I'm going to stop here, and I'm looking forward to your comments and questions.
We have a question here from Clive Bullen asking, has change in culture norms changed the male-female pay gap, racism, etc. in financial trading at all? And by how much, if so?
Yeah, I think that's a natural follow-up question from the discussion. So there have been numerous efforts to address issues such as the male-female gap or racism and discrimination. The Banking Standards Board, for instance, has been for almost a decade running surveys about these issues. And it seems that the banks have grown a great deal of awareness about this, also in response to well-known, very prominent events such as the Me Too movement and other issues also coming from the US. So certainly these issues are more prominent, and the banks have also adopted some measures that can help with, for instance, gender equality and in general DEI, like for instance, new policies that allow people to work from home. The challenge that I see is that having separate departments in organizations such as HR, compliance, or even a culture team that is trying to change those attitudes from afar is tricky. I think that the way to really make change happen is to run that through the chain of command. Because at the end of the day, it's really when your boss is concerned about something, your boss clearly takes a stand against discrimination or is aware and sensitized to the problem of the gender pay gap, that things are bound to change. So I think that some progress has been made, but I think that there's still a lot of progress to make.
Yeah, excellent answer there, Daniel. There's a follow-up question from Hugh Purser. Could you please expand on what you mean by self-condemnation?
Yeah, self-condemnation is a very simple emotion. You do something that you think is wrong, and immediately the way that we all function is we feel bad about it. And when people repeatedly do things that they think are wrong, then what experiments have shown is that they even have physical reactions. So some people get sick, some people lose sleep, some people show the typical signs of stress. And so this is a natural mechanism that sort of like it's almost like a physical enforcement of norms. This is why people prefer to follow their own norms. Now, if you haven't internalized certain norm, if it's a norm at the organization that you don't believe in, that is not your norm, that you think is inappropriate, then of course you don't undergo any sense of self-condemnation. So the critical development is when there is disengagement, which means when people reach a point, having been repeatedly felt unfairly treated, that they no longer experience self-condemnation when they don't even follow their own norms. And that's where it's really dangerous to have somebody in that situation in your bank handling capital.
Eugene Kiernan asks, seems to suggest there is no one fits all in improving culture, yet many regulator policies, etc., are top down. Perhaps no one fits all rule in improving culture. Sorry, okay. I'm just trying to get a grasp on the question.
No problem. I know sometimes it's difficult to read comments that are maybe typed, limited time.
Yeah, I think that might be my mistake. But yeah, and I guess the other part of that, given that it's a two-part question, is it mainly sort of a top-down thing, or is there a grassroots element to this culture that you're describing?
Yeah. So one of the takeaways from the study that I did is just how difficult it is to try and effect change from a purely top-down approach. It's just extremely difficult. You have an organization of 60,000 people. You have an industry made up of multiple organizations. It is going to be very difficult to change the culture. Generally speaking, the organizations where there's a great deal of cohesiveness around shared beliefs and values tend to be organizations that have grown organically and that are still being run by the founder. Anything else that is not that, where you have one CEO coming and then after 3 years on average another CEO comes in, cultural change is going to be very difficult. And so that is part of what the regulators and the reformers of the industry are up against.
Okay, yeah, it was a one-size-fits-all approach to culture there. Apologies from me. Another question from John Knights. In an increasingly complex world, isn't it necessary to reduce hierarchy, disseminate decision-making of command and control leaders to dominate the banks are appropriate for future?
Yep. Thank you for that. So the question, if I understand correctly, is about what is the proper role of hierarchical relationships in a setting that requires innovation and creativity. And I think that that is something that we hear very frequently. organizations should be run in a way that is less, with less of a hierarchy. And I can definitely see the advantages of that for the purpose of achieving innovation. But if the past 10 years have told us something of the technology industry, Facebook, Uber, etc., is that extremely flat organizations can also lead to abuses of technology. And so now, it's no coincidence that there is a very different societal perception of the tech sector, because now we know that, the data is being used for sometimes dubious purposes, such as modifying election results, etc. So the takeaway of my fieldwork is that in addition to espousing a discourse that favors innovation, it's important not to forget also about the other side of the coin, which is preventing abuse. And that preventing abuse is very difficult to accomplish effectively from some corporate function unit sitting somewhere in the headquarters, because norms are very difficult to enforce in that manner. It's very easy to come to injustices. Instead, what you need to do is have proximate control, proximate enforcement, and this is bound to be from the person who is close to you, which I would argue is the line manager. So to me, as much as it is extremely contemporary to emphasize innovation and the lack of hierarchy, to me, the one thing that became clear is that hierarchy is necessary to prevent opportunism.
Okay, great. Paul Phillips has asked, does a move to work from home damage company culture, or sort of does it demonstrate an organization's culture? So can it exist not only in an office setting where everyone is in one place, but sort of where there's more of a diaspora and all the company's employees are around the world?
Yeah, that is an extremely important question and debate. I think that, well, first of all, let me point out that my data does not speak to this issue, because certainly for the purpose of this book, the book was published in 2019, so the COVID pandemic had not taken place yet. But there's one thing that comes across clearly from my observations, is that unexpected encounters inside the trading floor between desks were critical to promote innovation and to help the traders understand the limits of the models that they were using to value a security, and to be able to avoid being sort of like caught with tunnel vision. So the manager of the trading floor himself was very keen on making sure that people were on the floor, that the floor wasn't too big, so that people were sort of like able to recognize each other. But beyond that, there were no observations on COVID. What I can say is that I followed the occurrence of the pandemic very closely and with a great deal of interest. And it's very interesting that banks took very different approaches to COVID. So some banks, which coincidentally it happens to be the US investment banks, had a very tight work from the trading floor policy all through COVID. 95% of the employees were working from home, but the trading floors were full of people. And the banks, and it so happens to be the European and Asian investment banks, had a very clear work from home policy. if one compares the performance of those banks during the first days of the pandemic, which is when the capital markets repriced securities in light of the pandemic, it's striking the profits that the work that of the banks that had the people on the trading floor made, because they were able to understand and to be ahead of the game and grasp that all stocks were mispriced because they were not incorporating COVID. And so in the 2-3 days of huge volatility, there were some very clear winners, and those winners, they had the people on the trading floor.
Okay. Naresh Sompar asks, there may be times when traders may distrust risk management since there may be a lack of understanding. For example, hedging an interest rate risk with a derivative which is more volatile than the underlying cash instrument, thereby creating more volatility in the P&L rather than less. It may be appropriate to underhedge to reduce volatility.
Yeah, and so is that a comment or is that a question?
I suppose that's more of a comment.
Yeah.
But it's a comment about risk management and what role that should play in these instances.
Yeah. So that points to. So I would agree. I would agree that it's rarely the case that people in risk management would be able to fully understand the most sophisticated trades, such as hedging interest rate risk. Now, having said that, it's equally important that a single trader should never be the only employee of the bank that understands a certain strategy. So there needs to be a supervisory relationship where that trader is being closely followed by somebody in charge. And so I think that this really points to the crucial tension that I was pointing to, that if you rely on a department somewhere out there, risk management, to manage the people, then there are bound to be problems there for lack of understanding.
Excellent. And Anna Reitman asks, what are the consequences to ignoring regulatory mandated risk calculations? Also, in an age where we're seeing human algo hybrid decision making, aren't norms themselves changing?
Yeah, so the consequences to ignoring regulatory mandates obviously can be penalized. But it's equally important to note that the regulators themselves have become skeptical of value at risk. And so if you look at what the Bank of England is doing, is they are now relying on stress testing. And now why is that? Well, clearly the reliance on stress testing and the emphasis on tail risks is a direct consequence of their understanding that value at risk, which is what was being used before, is a very limited tool. But notice that as much as it was a limited tool, it was at the center of efforts at managing the capital requirements of the banks. So the situation is one that really needs reflecting on, because the regulators themselves are exerting control, but doing so with a tool that they themselves no longer believe in. And for that reason, they're using something else. So if you're a bank, you have to abide by the risk controls that are being mandated by the regulator. But that doesn't mean that we all have to accept that this is the way to go. I think that the regulators are relying on control at a distance. But if you are a bank, you have to have those numbers, but then you should also have the supervisory relationships where the actual risk is being managed and not just managing a number.
Okay, and I think we'll just close by asking a question that was sort of retreading a question that was asked previously, but with a slight rephrasing. So John Knights has just asked, in an increasingly complex world, isn't it necessary to reduce hierarchy and disseminate decision-making of command and control leaders that can dominate the banks? Are these types of leaders appropriate for the future?
Yeah. Yeah, so like I said, I think what you need is a combination of decentralized authority, but also there need to be adults in the room. And I think that part of the problem during the global financial crisis, which let us remember was also a time of a huge deal of innovation, financial innovation. What ended up happening there was that the banks were not fully understanding the trades that some of the traders were putting together. So I think that the experience of that dictates a degree of caution. And it's one thing if you are developing a new technology, and it's something else if you are handling billions and billions of capital.
Yeah, it's interesting because on my to take things back to my Cultures of Capitalism module that I did with Ammon, your colleague, he highlighted the long-term capital management sort of fiasco, and how these models were so complex that it was difficult to regulate them because there was very little understanding surrounding them. So
That's
I
right.
wonder how it could be that there would be a level of culture intertwined with that sort of complexity of mathematics that is sort of dictating how people run their jobs on a day-to-day basis. It would seem like a difficult situation.
Yeah, but the paradox is, in the case of long-term capital management, is very illustrative of this. Is that in the end, the organization failed because it trusted too much in the models that they had developed. So I think that that's another case that sort of like strongly suggests the importance of caution when using financial models. And whereas existing studies of long-term capital management have emphasized the losses and the crisis and the problem, what my book does is try to show how internally a financial organization could be structured so as to not only rely on the models themselves, but also on subjective judgment of the managers.
Well, thank you very much, Daniel. I'm very sorry to the audience and you, Daniel, that I'm afraid my internet completely collapsed halfway through the event. So first of all, a huge round of thanks to Sasha for stepping in to chair the Q&A. I did hear the end of it, and I will be going back to watch the recording. And otherwise, other thanks are in order. First of all, to our sponsors again, we are very grateful for your support, which enables us to keep this interesting conversation going about the world of economics, finance and technology. So many thanks. But really just to thank you, Daniel, for a fascinating presentation. You will all go out, of course, and buy Daniel's book, and we'll make sure there's a link to the book in the follow-up email. I'm certainly looking forward to reading it myself. Forthcoming events.
Thank you, Michael.
That's a pleasure. Just forthcoming events this week, satellite technology for assessing global terrestrial carbon stock tomorrow. Really quite an important issue, and looking at different ways in which satellites are used to look at different
yeah, I think Mike's internet may well have cut out there, so I'll just close out the session since we're very close to the end now by mentioning that on Thursday we'll be launching the GFCI 34, and then we'll have a physical event that evening talking about the creating real business value from AI. So Daniel, thank you very much again. An incredibly interesting topic, and I think from the questions that we received from the audience, they very much enjoyed it. So we very much appreciate your time, and thank you everyone for attending today. Have a very good afternoon.